Why did SpaceX record a staggering $4.94 billion net loss right before executing the largest initial public offering in financial history? Let us analyze the corporate strategy behind the numbers. On Friday, June 12, 2026, Elon Musk's aerospace giant officially lists on the Nasdaq under the ticker SPCX. The corporation is targeting a record-breaking $75 billion capital raise, already drawing over $150 billion in institutional book-building orders, leaving the IPO oversubscribed by 2x. For senior management and board members evaluating this multi-billion-dollar deficit, this is not an operational shortfall. It is an asset consolidation driven by a massive corporate combination. In early 2026, SpaceX merged with xAI. Corporate financial standards require SpaceX to present consolidated financial statements, pulling xAI's capital-intensive tech deployment into its historical reporting. On a standalone basis, SpaceX's primary connectivity engine is highly profitable. In fiscal year 2025, Starlink generated $11.4 billion in revenue and delivered $4.42 billion in operating profit. This operational strength allowed parent company SpaceX to report a consolidated net profit of $791 million back in 2024, before the capital-intensive consolidation of xAI shifted the aggregate 2025 bottom line to a net loss. The institutional excitement centers on strategic capital expenditure. Out of $20.7 billion spent in 2025, SpaceX deployed $12.7 billion, or 61%, directly into building out xAI's compute infrastructure. Morgan Stanley reports that by blending low Earth orbit satellite mesh with frontier large language models, this space-based data center model could scale the enterprise to a projected $3.4 trillion in annual revenue by 2040. Crucially, market mechanics protect the public debut. Index rules allow fast-track inclusion into the Nasdaq 100. This happens within 15 trading days of listing. The inclusion triggers an immediate, mandatory passive bid. Large index funds must systematically buy millions of shares. This creates a solid institutional buying floor. Because of this guaranteed demand, Wall Street is highly confident. They are lifting the valuation from $1.25 trillion to a $1.77 trillion public powerhouse. For corporate boards, the lesson is clear. Do not confuse aggressive infrastructure deployment with a lack of profitability. Is your enterprise allocating capital for the next decade or just the next quarter? Scan the code to connect on LinkedIn for deeper financial analysis.